I attended a boarding school in Nigeria, and in boarding schools in Nigeria, you're not allowed to actually have money, physical money in school. So our form of, I guess, transaction was by barter, and the main form of trade was food. So food was the main thing we bought and sold things of. And for me, I mean, it's ironic that what taught me about money had nothing to do with money. It was actually the store of food. But I learned so many principles that apply in life and how I invest from my experience there. So just to give you like a short story, the most precious food was chicken, and in Nigeria, chicken is very spicy. It's kind of like part of our culture, and everyone eats it. But that was the most precious food. Now the issue with chicken is that you have to eat it immediately because it's served during lunch. Growing up, people would trade anything for chicken just so they could have it right now. And at some point during my journey in secondary school, I realized it's a perishable good, and people want it right now, so they're willing to pay anything for it. And I think the first lesson for me was the idea of delayed gratification. Rather than having the chicken now, I could trade it with someone else for something much more. So again, I started trading it for, plantain chips, which are just basically crisp, and I'll trade it for like 6 plantain chips. And then later in the evening, when everyone's hungry, when they're supposed to have had their crisp, they wouldn't have that anymore, and then I will then trade 1 crisp for 3 pieces of chicken the next day. And for me, that was trade by barter. But it taught me about things like delayed gratification. It told me about the importance of scarcity. It told me about just being able to understand how people value things. And when you understand how people value things, you can definitely make investments or make trades off that. And that for me was my introduction to the world of business.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Dede Eyesan. He's the visionary founder of Jenga Investment Partners and author of Global Outperformers, who shares insights on identifying high-growth companies and navigating global markets with a unique blend of fundamental analysis and entrepreneurial spirit. How are you, Dede? So nice to see you again.
Yeah, nice to see you. We haven't caught up since Berkshire Hathaway last year, and it's good we're going to be there next year. But I'm doing well, thanks. And yourself?
I'm doing great. I enjoyed meeting you in person in Omaha through some mutual friends, and I followed your work for a while. I mentioned to you that Chris Mayer introduced me to your book, Global Outperformers. He wrote his 100 Baggers. That was a very successful book that I go back to quite often, and your book takes it to the next level, if I can say so, and we'll talk about it more in a second. I want to jump right in, and you might know that I like to start those conversations with the early days. I know you have stories. I know a little bit. I want to learn so much more. But tell me about your childhood upbringing, and how do you think that time shaped you?
your relationship with money and the path that you chose, the career that you chose.
Before that, I think I was just going to say thanks to Chris Meyer for sharing the book. And I remember the book was out a month before he tweeted about it, and no one literally read it. And then the moment he tweeted about it, I had like an influx of downloads. So a huge thanks to him for sharing the book with his network. But on my side and growing up, so I'm Nigerian, and I've lived in the UK for the last 10 years. I made my first investment at the age of 10, and my story in terms of my introduction to the world of investing in business is kind of split in two. The first bit was really being my direct introduction to the world of investing in stocks. So my parents, they invested and saved, and it was a bit popular to invest in the multinational companies operating in Nigeria. And my dad had done so in the 90s. And in 2009, I was age 10, which kind of gives up my age right now. He gave me the option of investing, and he told me to pick companies I wanted. Out of the list of 100, there were literally only 3 companies I could recognize the names. Nestle Nigeria, which made the most popular hot chocolate brand called, in Nigeria we call it Milo, but outside people call it Milo. I still drink it today. The second one is 7-Up bottling. I then thought it was the actual 7-Up brand, which is like a carbonated beverage, but was actually just the bottling company. And the third one was a Nigerian bank called First Bank of Nigeria. So 5 years after I made the investment into 9, 2 had gone up 4 or 5-fold, so Nestle Nigeria and 7-Up. And of course the one that fell by half was the bank. I remember 2014-15, I really wanted to understand, why exactly had, these shares changed so much in value. And that was really my introduction to the world of, balance sheets, income statements. I then came across Warren Buffett online, and the whole world of investing kind of exploded from there. The second side, I guess, to my introduction on investing is more of the business and the finance side. And I think in the world of fundamental investing, it's easy to forget, at the end of the day, what we're looking at is about businesses, understanding the flow of money and finance and value. And for me, this was more of a childhood story. So I attended a boarding school in Nigeria, and in boarding schools in Nigeria, you're not allowed to actually have money, physical money in school. So our form of, I guess, transaction was by barter, and the main form of trade was food. So food was the main thing we bought and sold things of. And for me, it's ironic that what taught me about money had nothing to do with money. It was actually the store of food. But I learned so many principles that apply in life and how I invest from my experience there. So just to give you like a short story, the most precious food was chicken, and in Nigeria, chicken is very spicy. It's kind of like part of our culture, and everyone eats it. But that was the most precious food. Now the issue with chicken is that you have to eat it immediately because it's served during lunch. Growing up, people would trade anything for chicken just so they could have it right now. And at some point during my journey in secondary school, I realized it's a perishable good, and people want it right now, so they're willing to pay anything for it. And I think the first lesson for me was the idea of delayed gratification. Rather than having the chicken now, I could trade it with someone else for something much more. So again, I started trading it for, plantain chips, which are just basically crisp, and I'll trade it for like 6 plantain chips. And then later in the evening, when everyone's hungry, when they're supposed to have had their crisp, they wouldn't have that anymore, and then I will then trade 1 crisp for 3 pieces of chicken the next day. And for me, that was trade by barter, but it taught me about, things like delayed gratification. It told me about the importance of scarcity. It told me about, just being able to understand how people value things. And when you understand how people value things, you can definitely, make investments or make trades off that. And that for me was my introduction to the world of business. And I guess life just took itself from there.
It's so fascinating how much we learn in those early years. You had a lesson what price is, value is. You're talking about delayed gratification. I'm seeing time arbitrage. I often say in my investment pursuit, managing money for families, I say, I don't think I'm smarter than anybody else. I don't think I'm faster than anybody else, but I can be more patient than most. Yeah. That's what I have control over, right? And that's what you were doing. You were doing time arbitrage here between different times of the day, but you could extrapolate it to years when the business can grow. And I like I'm going to call it a Peter Lynch's influence here, and I'm curious if that's how you see it, that you were looking in your shopping cart for your investment ideas. You know, people are trying to find something exciting to invest in, and Peter Lynch reminded all of us at some point in his books, just look in the shopping cart. What are the brands, the businesses that you value already in your life? Because you might know more about them than many other people, especially the ones sitting high up in a high rise in an office that have never, it's been a while since they went into a supermarket and actually picked up something from the shelf.
That's a good point. And I remember Nestle Nigeria, one of the companies I invested in. I mean, there was Cadbury. I didn't realize Cadbury made the other hot chocolate brand, which was called Bonvita. But when I found out, I just told myself, I actually want to stick with Nestle Nigeria. Why? Because I drink it, all my friends drink it, and we all hate Bonvita. And if you look at the share price, like since 2009, Cadbury Nigeria is down by half. So you've lost 50% since 2009, whereas Nestle is up like 8, 9, 10-fold since then. Even though I didn't know the financials, I understood what was working in the Nigerian market as a young Nigerian, and that's kind of what was reflected in the stock price, where, you know, the fundamentals kind of just drove the share price, and that was really my lesson, my key lesson as an investor.
And I want to also highlight the fact that you mentioned that you learned so much about money without money, and it's isn't it fascinating how you think you grew to appreciate what money could represent, purchasing power could represent in your life at that time and later on, without money being even in the room or in your pocket. I think there's something deeper there where you need to appreciate. And I think it's also an exercise that showed the economy, some sort of an economy, was running really well in your school. It's, to me, what you guys were doing is just human experience. We are here to exchange things. I know something you don't know. Maybe you'll pay for it. I have something you don't have. Maybe you'll pay for it. And this is a natural flow. You know, we call it trade at a nation's level, but it's an actual economic exchange. And you were learning it as you were going to school. Maybe that was, do you think that was as valuable as the actual classes you were taking or more?
I think you've put it really nicely, and to be honest, I never thought about it that way, and now that you've said it, you know, it actually makes a lot of sense. I don't want to discredit my teachers because they did quite a good job teaching us, but I would say when I think about life today and I reflect on those lessons, I would say it's been very instrumental. And, you know, as an investor, the idea of just delayed gratification and being able to operate in an environment where resources are scarce, I think it's framed how I think about my life and also how I think about entrepreneurs and businesses I want to invest in. So overall, it's been very instrumental for me.
I see that. I want to ask you about your dad. He was interested in investing. Can you tell me more about his experience and how that influenced you? Were you looking over his shoulder? Was he introducing you to ideas? How did that go?
So both my parents, my dad and my mom, they were traditional retail investors. You know, they didn't have like a finance background. They had their own careers 9 to 5. But my parents always wanted to prioritize my education and being able to send my siblings and I to schools abroad. And that just meant they had to invest and save well. And I think one half is investing. My parents were curious and they wanted to understand, you know, what were the other ways that we could, you know, invest our money. And that was how they were introduced to the world of investing. We didn't discuss you know, stocks around the world out there. And my parents have only invested in the Nigerian stock market. Even to today, I tell them, you know, sell the Nigerian stocks and buy the US. They've refused and they've stuck with the same Nigerian companies that they invested in. But when I look back, I mean, it's taught me a lesson about compounding. So especially Nestle Nigeria, because that's a stock my parents have had since the 80s. It's gone up 100 plus fold. I know half of that is probably just inflation in Nigeria, but the other half has been Nestle being able to reinvest and grow their products. But they've done really well, and that was my introduction to investing. Just the idea of just being able to compound, keep things simple, focus on what you know, and own it for a long term through shocks, economic shocks. Yeah, that's been a big lesson for me.
It goes without saying, but I'll mention any stocks that come up in this conversation are no recommendation. Do your own research. See them as case studies. I'm curious about the early books, mentors, experiences that solidified your investing philosophy in those teenage years before you jumped in as a professional. Can you recall some of the names that had the biggest influence?
Yeah, I can. And I think once I figured out why Nestle and 7-Up had done really well, I keep going back to Nestle, but it was really instrumental for me. But once I had figured out, you know, this is what investing is about, I just literally did a Google search, who's the greatest investor, and this guy called Warren Buffett that we're going to see next week came up, and I just read as much as I could about him and watched his interviews, and that's really shaped my investing process. Now, the challenge, I guess, with Warren Buffett for me was coming from Nigeria. It kind of felt far away. I never really saw myself ever being in the US. You're a young Nigerian black guy. It's kind of difficult to relate to his story. So I decided to search about investors who I guess had come from emerging markets who kind of applied similar principles in their investment philosophy, and two particularly stood out to me. One was called Alan Gray. He passed away a month after I started my fund, and he is probably the most successful African value investor out there. So he started 3 different firms, one in the UK, one in Australia, and one in South Africa, and he's built a phenomenal track record. And he only has 2 public interviews online, but if his firms have written lots and lots of, investment thesis out there, and you can see his influence across the firm even to today. So the lessons I learned from him, one was about investing, and 2 was about building a good investment firm, where there's a culture of performance drive, there's a culture of putting clients first, and they shared a lot of their resources out there. So he's someone that I would say has really influenced me as an investor and also as an entrepreneur. And then the second person is Carlos Slim in Mexico. So most people know him as a monopolist who conquered the telecom world, but there's an investing element to Carlos Slim's life, and not many people know this, but he was actually a student of Benjamin Graham, like Warren Buffett. And I think after university he traveled to the US and just wanted to learn everything he could about investing, and came across Ben Graham. And when you look at when you watch a lot of his interviews and you read the books written about him, he talks literally about the same principles as Warren Buffett. The only difference was that Buffett being in America, he was open to companies that could compound without his influence, because you had a great system politically, economically, and there was an incentive for people to do the right thing. Whereas in Mexico, that wasn't necessarily the case. So he was a bit more involved with the companies, and he would have a team who would actually fix things and try and drive value in a constructive way. So he had a very different approach. And what that taught me was that it's normal for your environment to also impact how you make investments. And he adapted Ben Graham school of thought to what worked for him in Mexico. And I'm guessing that's been a key reason of why he's been successful. So yeah, those 2 alongside Warren Buffett have been the most influential for me. And of course, there have been lots of books out there. My favorite books that I try to reread whenever I can are the Peter Lynch books, Beating the Street and One Up on Wall Street. Peter Lynch is a phenomenal guy who, was growth-minded, at the same time could look for the cyclicals and the compounders. It was almost like 4 people in one, but his books were really instrumental for me and still are today.
Today I manage money for families, long-term patient capital, run stock portfolios for them. But it all started with Peter Lynch's book, One Up on Wall Street. And I have great gratitude for him writing that book, because I was a student, taking courses in business, finance, economics. And his book showed me the way that this is something I want to do. And I never looked back. I want to ask you about Global Outperformers. You did your research. You wrote a book. You took this idea of finding companies. You talked about Nestle, but there are others. And we don't have to mention individual stocks, just the qualities about them. Tell me about the appeal of finding them. Tell me about the fact that you went global looking for them. And it's such a long runway. It takes a lot of waiting. And I'm guessing you're patient and you can wait those years to see those kinds of returns. But tell me more about that experience, the research, and what you found on the way.
I'll break it into 2 parts, I guess. The first one being about why I wanted to write the book and how that came about. And then the second bit being more about the content, and I guess we can dive more into that later on. But I had come across Chris Meyer's 100 Baggers book, and there was another report by Alta Fox who looked at 5 baggers in 5 years, and I kind of wanted to combine both research papers. With Chris Meyer, he had focused more on the US businesses, and for me, coming from Nigeria, living in the UK, I would love to invest in the US, but I would also want to look globally and things closer to me. So I thought, it probably would be a good idea to look at things at a global scale. The 10 years in the one 10 bagger in 10 years was an area where I felt like I could add a bit more from a literature view. So that was really why I prioritized, that bit. For me, the goal of the research was to help me become a better investor. I'm a huge believer, and when you look at Warren Buffett, Alan Gray, Carlos Slim, the greats, they're also huge believers who stood in the past and seeing what worked, what didn't work, and why they happened. They got their results. So I thought, in the last 10 years could really help me. One, I get to learn about businesses today. Two, I get to learn about markets, geographies, and three, I get to learn about why they've actually done well. And that was the main driver of why I did the book. And doing the research, I kind of had like a blank sheet of paper with what I thought I would see. Sadly for me, what I actually saw was totally different in terms of the results, where the multi-baggers came from, the countries, the industries, the journey over the 10 years. I initially thought it was going to be like a straight line where every company had just grown 20% each year. That wasn't the case. I thought it would be the same businesses that were multi-baggers the decade before, but I realized they were actually very different companies. And I think just like 5-6% were multi-baggers in both decades, so 2002 to 12 and 2012 to 2022. Yeah, the results are totally different, so it was a huge learning curve for me.
What did you think you're going to find, and what did you find?
So I thought I was going to find 200 multi-baggers, 150 in the US, and then 50 scattered around the world. I thought they were all going to be in technology industry and maybe a few in healthcare. Turned out that less than 20% were actually in the US. So you actually had more multi-baggers in Europe than in the US. And rather than 200 companies, there were 446 companies. And then technology, I think, was about 20%. Quite a broad split. You had 15% from industrials, 18% from materials, which was very surprising. I mean, for me, I've always seen materials as a cyclical industry where, it does well for 2 years and then that's it. But that wasn't really what I saw in the results. So yeah, those were the big differences. And there were some countries that I just thought had no chance of outperforming. And I mean, one of them was Japan. I thought, Japan would probably not be there. And then Japan was actually the third best performing country. And there were reasons behind that. So that was a huge surprise for me. And there were lots of, these little things. And each was just a learning curve.
There's this argument against active management. And I am an active manager. You are one, and many of my guests are practicing active managers. One of those arguments is this Besson-Binder study that you might have seen, how only 1% of companies created all the value, right? And I think of it, that's one dimension of looking at it. The companies that you talk about, and I'm curious to hear more, I imagine that they were relatively small and they became much, much larger, right? So when you really think about deploying capital, you don't have to be in the absolute largest company that turns, 50 billion to $1 trillion. You could be in a company that turns $1 billion into 50 billion and 2 billion into 100 billion. And they might not be captured by a study like Besson-Binders, but it doesn't mean that active management doesn't work because you have to own 5 stocks, and if you don't own them, you're lost. That's not true.
Yeah.
I'm curious how you look at it, and if you can give us some flavor, and I know it wouldn't be one profile, but maybe a few profiles without names, but just like the quality of the companies. What is it about them that allowed them to scale so much and be such successful investments?
Yeah, I mean, before diving into the answer, only one of the big tech companies was an outperformer among all 446. That was Amazon, which is a huge surprise because, I also expected all of them to be among the outperformers. So it just shows that there are lots of different industries, markets, business models, business types that you can invest in to outperform. So I wouldn't say there's one formula. I mean, the formula is to look for great businesses that are undervalued, but that could mean so many things. And when I reflect on the book, there were lots of different businesses, or lots of different business models. One of the popular examples were cyclical businesses with technical barriers to entry. So what that basically means is that if you look at their financials over a 20-year period, there'll be periods of low profit margins, high profit margins, or even potentially losses. But at the same time, it's impossible for a business that's not operating in that industry to enter. So one of the industries that came up was the salmon industry. And salmon is something that's predominantly just grown in two countries, Chile, South America, and Norway. So you can't, that's for a geographical reason. There's like aquatic reason behind all of that. And as a salmon company in Nigeria, for example, you can't just randomly wake up and say, yeah, I'm going to take market share from Norway. There's not enough salmon in the seas by Nigeria to compete with them. So that's why I call technical barriers to entry. And the reason why those businesses can outperform is that during the downturn, you don't have new entrants who kind of like change the dynamic of the market. So you have the existing players, they all downsize, they wait patiently for the prices to return. On the demand side, like people are always going to eat salmon year in, year out, so it recovers at some point. And for me, before the research, I wasn't really open into cyclical companies because I would love to be in businesses that, you know, are steady, high growers, but I realized it's actually okay to be in these technical barrier to entry cyclical businesses because they have that protection. So that was one form. Another popular form where businesses operating in large markets, operating in large markets and solving a customer needs. One of the examples there was BYD in China. I mean, China is a market of 1+ billion people. If you're addressing something where you're trying to make a car for everyone at a lower cost than anyone, that's cleaner than anyone,
right,
with a vertically integrated supply chain, that's really ambitious. And that's what companies like, you know, BYD in cars in China were doing. Now, I think the trickier bit is figuring out if they're going to be a winner. And for me, I realized that's the real difficult bit. And the solution as an investor is to focus on the unit economics relative to all the peers in the industry. So how much, BYD's case, how much does BYD make on one car? What's their cost structure like, and how is that going to advance as they scale more cars? And when I look back, even in 2012, then they were more focused on the battery division. Even when you looked at things then, it was quite clear that, you know, they had that, you know, competitive advantage. And also when you look at the management, you know, the focus founder and the management team have, it's unparalleled, and it's very difficult to compete with businesses like that. So I mean, for me, those were the two buckets of businesses that looking after, you know, the research, I was like, yeah, these are the two that I really want to focus on going forward as an investor.
Two very different buckets, right? One, cyclical. A lot of people feel very uncomfortable owning cyclicals. I think maybe because we tend to buy them at the wrong time when we feel like, oh, it's no longer cyclical, until they remind us that they are actually cyclical.
Yeah.
And you have operating leverage and financial leverage working against you, which is not that enjoyable. And if there are a few players, maybe one of them will not survive. That's the reality. Maybe it will be absorbed by the other. And the other one is an open-ended growth opportunity that you described. The market is so big, the opportunity is so big, and you can just ride it. I have one big question. You find the right idea for the right reasons. What makes you hold it through some really tough periods? And I asked that Chris about it, because he told me that dead money periods are harder than drawdowns. Because drawdowns, eventually, you know, you see the bounce back. Dead money, you don't know if you're still waiting for something worthwhile or not.
One of the case studies we did in the book, but these are no recommendations, but one of the case studies I did in the book, because I looked at like case studies from each industry to just have a deeper insight into what's the journey like. And we also put the financials over the 10-year period, so you can see how, you know, the earnings and revenues grow over time. One of the companies that we looked at as a case was MSCI, you know, the the data platform for financials. And between 2007 and 2016, the stock literally went nowhere. Now, during that period, the earnings compounded by 15% each year for 10 years, and the stock went nowhere. I think it went from like 30 to like 48 or something like that. And then after 2016, like between 2016 and 2020, then it shot up like fourfold or fivefold. And, you know, looking back, it can be very frustrating holding during that 8-9 year period, and you're like, you found a good business, it has really good economics, it's growing, it has, you know, a growing market share, and you're like, for the last 5 years, it hasn't gone anywhere. And I think my takeaway is just a reminder that you have to go back to why exactly you bought the stock. I didn't buy the stock because it went up fivefold before I bought it. I bought it because I believe the economics, the fundamentals are going to be even better going forward. And if that reason is still in place, then it makes sense to just hold the stock, probably even buy more if you think it's become more undervalued, rather than bailing out because it hasn't done anywhere. And I mean, one of the other lessons I learned from the book was, if you looked at the trailing 3 years before they became multi-baggers, a lot of them either were flat or had gone down 40-50%. Like if you look at the salmon companies, between 2007 and 2012, they had gone down by half. There was a downturn in the salmon industry. And that's kind of part of the multi-bagger challenge of holding these companies. And I mean, for a second book, I mean, I have an idea of finding maybe 10 of these companies and looking for investors that held on to them for 20, 25 years and just interviewing them about their journey of holding that stock. And someone else could write this book, but really interviewing them and just figuring out, their psychology behind holding these companies for that long. Yeah, that's the real challenge, investing in them.
It's no endorsement of Berkshire. We both appreciate what Buffett has done in terms of education, but every year I go to the meeting and I take the shuttle in the morning. It's almost always I run into somebody in that shuttle who has held shares for decades. And these are down-to-earth people. Usually it's a couple. And very kind, very honest, very genuine, start telling these stories, how they bought the first share. And I see so many things listening to them. One, they didn't have the analytical expertise to judge that Warren Buffett will turn Berkshire Hathaway into what it has become. I don't know what it will be in the future, but we can look back and see what it has become. Second thing is, they not only bought it, they haven't sold a share for a few decades. And you meet people like that at a handful of annual meetings out there, but I always have huge respect. So they didn't have to be competent in a traditional way. They just knew that they picked the right business for the right reasons and the right manager in this case to run it, and they let it be. It's the coffee can portfolio taken to its limits, the idea of holding something and never selling. I think I'm pretty convinced that there's less competition in this kind of investing than trying to figure out how the next quarter will look like or how the market will respond to this headline or the other headline. So when people say investing is competitive, I have a follow-up question. What kind of investing do you have in mind? Day to day, you and I can bet if the market will close up or down. Halfway through the day, it's pretty obvious, but a day before, we don't know. And it's a coin toss, 50-50, statistics tell us. But if you have a longer period of time, and if you put some thought into it, the odds clearly improve. I want to ask you about something as I'm listening to you. You're doing your analysis, and there are some quantitative and qualitative elements to what you're doing, right? And we can run a screen, put in certain expectations. I noticed that even the two different buckets will show very different margins, different returns, right? So it's not one even screen. But beyond that screen, you have a list of companies, and you go with your qualitative hat, so to speak, right? And you go in and say, well, this one doesn't have a chance, and this one is what I'm looking for. Can you talk about that side, the qualitative side, what you're looking for?
I forgot to mention, but one of the areas one of the hypotheses I was, trying to check when I was writing the book was, can outperformance be screened from a quantitative standpoint? And the answer I concluded on was they can't, because they just look so differently. It's common to maybe screen for companies that have, maybe like a return on capital of 15% and EBIT of 15%, but, some of those businesses will stay that way forever, some wouldn't. And the reason is not because they had it for 5 years, it's because of the qualitative aspects of the business. And as I become more experienced as an investor, I learn the importance of quality and qualitative aspects of understanding the business. And I think it's really important as an investor, especially if you're not trying to play the quarter game and you're trying to play the long-term game, to really understand these qualitative aspects. So that was my conclusion, that I can't really screen things based on quantitative aspects, and I really have to consider the qualitative aspects. I mean, internally, what I've done is that I've now built like a checklist of 60 questions broken into 10 different parts, and that has allowed me to really understand the quality and the qualitative aspects of a business. So it starts off from barriers to entry and the nature of demand, and then it concludes on things like culture and the test of time. Test of time is just basically saying, have you passed a 50 or 100-year test, or test of bad management, or test of experiencing recessions, economic shocks, trade wars, those sort of things. The challenge is that it's a long process. You're going to spend so much time, thinking about the business, and I think it's better to play deep rather than volume. And that's another aspect of my investing, I think, also has changed since writing the book. When I wrote the book, I was like 446 companies. I could look anywhere and be like Peter Lynch and buy thousands of companies, but it's very hard to look everywhere. And I'm trying to focus a bit more on areas where I want to focus on. And so it's more about focus for me now, and that's what qualitative aspects of investing, I think, brings.
It's about the depth. You can go so much deeper on fewer companies. As I'm listening to you, I'm thinking of how we think of value investing, and I would divide it into two different ways. One is static, one is dynamic, and I'll explain what it means to me, and I know it means different things to different people, but I'm listening to you, Chris Beck, who was on the show, who teaches the original security analysis at Columbia. When I think of Ben Graham, you talked about Ben Graham at the beginning, he had the experience of the Great Depression. There was a time where there was no future. It felt like there is no future, right? So he would buy companies that you could liquidate and get more cash than you paid for it, right? So to me, it's static. You're extracting the value that's already in the business. And by the way, Buffett's purchase of Berkshire was not that different. It was very Buffett-like. And then there's the dynamic way. And the difference to me is if you buy a $50 stock at $25, and over the next decade it remains a $50 stock in terms of intrinsic value. It's a range. It's not set in stone. But then all you can gain is that the 100%, and you walk away, which is actually what Ben Graham did, rinse and repeat over many years, except for one stock. And then the dynamic one, you buy something at 50. Let's say you buy it during a downturn for 35, but this 50 could be a $500 stock, maybe a $5,000 stock. And in case of Berkshire, it became hundreds of thousands per share for the original share, right? So that's the dynamic where you're asking a bigger question, what this business could be. I wrote a piece, 20 Stocks for 20 Years, where I was trying to understand what kind of a business would I be willing to hold on to for 20 years that deserves to be held for 20 years. It's not just it will be around in 20 years, but it deserves the time, right? It's a very different way of looking at it. But I find it very, very interesting how that's a different way of looking. I'm curious, you mentioned how once Chris promoted your book and more people heard about it, you got a lot of feedback. Tell me about that feedback. What have you learned after hearing from people, reading your research and reacting to it?
When I wrote the book, I actually didn't think many people were going to read it. And for me, it was just more about being able to improve my investment process. And I just felt, one of the great things about the value investing community is that a lot of people are open. And my friends who have gone into other types of businesses, they always tell me, Dede, you're quite lucky that we're in a business where people who are also playing a similar game are willing to share what they're doing. They're willing to tell you what stock they're buying or even going to buy tomorrow. For me, logistics, no one's going to tell me the profitable routes to move my truck. So it's a real privilege to be in an industry like that. So for me, I wanted to, I guess, also share what I was working on. But thanks to Chris Meyer, a lot of people read the book, and I think the feedback was mixed. There were some ones, I guess, areas to improve or just things people had noticed. So for example, I hadn't factored in the currency impact on 10 baggers. So again, a company might be a 10 bagger in US dollars. So it will be a 10 bagger in Indian rupees, but might not be one in USD. So there was that element in terms of being able to look at it geographically. So if I was ever going to rewrite a book, I would probably have factored, USD into all the share price currencies. And I guess another on the more positive side, another, I guess, feedback that was more of things to improve on was people also wanted to see the impact of A. If I was a much better data analyst, I'd probably have been able to scrape, all the M&A data and kind of like checked, how much of earnings improved just from M&A, so people could actually see the impact of M&A in terms of the journey to outperformance. So that was something a lot of people said they'll have loved to see. But on the flip side, there was quite a bit of good feedback. I think people liked the case studies a lot, and the fact that they could see 26 different examples, look at the financials, read about the story. People also appreciated the geographic split. and the sector space, so they could actually see, where do these outperformers come. India was the highest performing, 90 out of the 446, and a lot of people had follow-up questions like, they never even knew India had that many companies, and now they started looking there, and of course, the market has gone higher and dropped a bit. It gave people a reason to look more geographically. So I'm quite pleased with the feedback, and for me, it's something that I've been able to reflect on and also improve my own investment process today.
I have so many thoughts. You mentioned something, you can see what other investors are doing. And I'm listening to you and the research you've done. I have this idea that you can't borrow somebody else's confidence. So yes, you can look up somebody's filing, and in the US it's very public for larger firms. You can see what they bought, but you will never have their confidence, right? So that's why I always feel like you're the one that looked at the company. Maybe you even visited the company. When the stock doesn't go anywhere for 7 years, I'm going to just remember it as I bought it because somebody I admire bought it. And I'll probably sell it first, right? But you will stick around because you did the work and you know exactly what's happening. You know where they are in the cycle. You know what they're dealing with. So that's why when people say you can just copy somebody, no, you can't copy confidence. You have to earn it. And you sometimes have to earn it with those long hours of going through things, going to the source and learning and getting comfortable with it. I want to ask you about the role of intuition. Do you think that intuition influences you at times in the process where you did all the research and there's something that tells you no, or go ahead?
That's a very good question. So my approach view on intuition as an investor has kind of shifted over the last 3 years. So when I started my investment process, I had a very detailed checklist, and I went through every single question before I made an investment decision. And when I reflect back, those were actually my better investments. And then over time, I think overconfidence kind of came in, and I'll look at a stock, look at the name, look at the numbers, brief through the annual report and be like, yeah, I think this is going to be a good one. And then I end up buying it and it doesn't work out. And I look back on why it doesn't work out, and I go through my checklist and I see, these 3 questions I probably should have asked myself that I didn't. And that happened a lot in 21 and 22. So I've kind of gone back to my original approach of actually having a very detailed checklist before I make an investment decision. That's not because I don't believe in intuition, but I believe intuition is earned by experience. So again, I'm someone who's in their mid-20s. I've been investing other people's money for the past 5 years. I think intuition is something you earn after 15 years or 20 years of actually doing investing. So that's my view. So until I cross the 15-year mark, I'm going to be relying a lot more on my investment checklist. But for others like Warren Buffett, who's done this for 50 years, they could literally look at the financials for 20 seconds and they have a perfect view of whether they would own this stock or not. But I think that's something you earn as an investor.
I think you make an interesting point that at some point that checklist, the filters are such a part of you, it's part of your DNA, that you might not even consciously know that you just run something through 7 filters and you say no. And to me, intuition, for lack of a better word, plays a role on the no side much more than on the yes side.
Yes side.
I've been in rooms with executives, so many over the years, and I found it really eye-opening to actually spend time with people that are running those businesses. And as a junior analyst, I would sign up for all the one-on-ones that were available with different visiting managements in New York. And there were meetings where I would walk away from the meeting, and I would say I would not leave my wallet with these folks. I wouldn't. And then if you cornered me and you said, show me in the statements, show me where, show me what, I would say, I don't know. I just wouldn't. One particular story, I'm not going to mention a stock, but somehow it's getting a lot of attention from one of the investors these days. It was in a previous reincarnation of it. I went away from a meeting with the feeling, 3 years later, they're in the headlines, CEO removed, accounting restatements, and borderline, I don't know if it was fraud, but it was not, the practices were not top notch, to be polite here. And I couldn't point it out in the filing, but just interacting with people that are running that business, I felt like I choose not to be a part of it. And I think it's a wonderful filter to have, and it helps me now and then, although I can't always pinpoint what's not sticking. I have 2 more questions. One about any hobbies that you have outside of investing that help you become a better investor.
Yeah, I play sports and watch sports, and there's a lot of analogies with sports used in investing, but thinking about that question, I actually don't think tennis has helped me become a better investor in any way. And when I reflect on life, I think it's mainly been more about my experiences with people and experiences in different environments that have influenced how I invest. So one of the countries that like we've been spending a bit more time on is Bulgaria. Part of my conviction for actually doubling down there has come from going to visit the country and just experiencing, you know, the feedback from people, how people look at growth, how people look at how companies and management, you know, think about, you know, operating with scarcity and profitably. So I mean, for me, it's what has, I guess, has influenced investing has just been more of my general experiences with people rather than hobbies.
So I went back to tennis after many years, and I play tennis now. And somebody pointed out to me that tennis, it's not only about you being good at it, but your opponent making mistakes or having fewer mistakes. I always say that I want to be the least wrong. You know, people go into investing, they want to be right. I just don't want to be terribly wrong, right? And I feel like the time and the compounding will work in my favor. I think there are those studies that an average investor over a longer period of time becomes the top investor because he's still or she's still around.
Yeah.
But I think there's a lesson. But when you talk about people, I think it's fascinating because I have this open-ended curiosity. It's a search of, you know, for understanding. And when I'm traveling, I hop in a cab, I'm talking to people. And I'm just learning about what's your life like? What's it like to live here? And it gives me all those little inputs. Not that I'm trying to use it in research but it just allows me to understand the world a bit better. And at some point, in some way, maybe it becomes part of that intuition we talked about, that I have this moment where like, oh, I don't think so. Or yes, because of a conversation I had at some point with someone that I may not even recall. I like that aspect. I have one big question for you. How do you think about success?
Ooh, that's a interesting question. So I think William Green has written this book about richer, wiser, happier.
Wonderful book.
Yeah, I think it's a wonderful book, and I think it's shaped how I view success. So I kind of break it down, success, into three areas: individual, career, and I guess family. Individual, for me, it's just being a state of happiness, being able to appreciate people around me, things around me, in my environment. And if I can be that for the rest of my life, that for me is, I would say, success as an individual. I think family is also an important pillar of life, and success for me is, you know, having loved ones around you and people, you know, being able to say nice things about you from a genuine place, both nuclear and extended family. And for me, that for me is a huge area of success. And I think as an investor, someone who is quite focused on their career, it's easy to forget both, but I think they're equally as important. And then on career, for me, I mean, the way I think about success as an investor, it's not really about how I feel, it's about how people who have invested with me feel and judge me. I want to be in a place where the kids of my investors in 40 years' time can look back and be like, yeah, my dad or my mom made a very good decision by investing with you 40 years. I still have a long time, hopefully, as an investor. So I want to be in that position where, you know, my clients are happy for decades. And that is what makes me feel fulfilled. That's what makes me feel like I have some form, I guess, successful. And being able to combine all three, I would say that's success. And when I reflect on mentors, Warren Buffett, when I reflect on the life of Alan Gray and Carlos Slim, I would say those are three people who were able to, at least from what I've read and listened to, they've been able to achieve all three forms of success. And I mean, that for me, I think it's how I define success.
I love the sound of that. I really like the aspect of thinking of whose money you manage. I think it's such an important thing, and you brought it up a few times in this conversation. I love the image of you thinking of the kids, of the investors that are with you. I work with families, multi-generational families with fortunes, and I knew the previous generation, I know the current one, I know the future one. And I see it as a lifelong relationship. You know, people I want to work with for decades to come. And I see great joy and fulfillment in it being a part of their journey. But to think for a second, not just the people that put the money in with you, but also the people who will one day say, wow, dad or mom or uncle or whoever it is, grandpa made such a wise decision to partner with somebody. I think it's such a powerful idea. Just going back to the couples you get to meet on the way to the Omaha Berkshire meeting at 4 a.m. in the morning. They did something right. And if they have kids and grandkids and nephews and nieces in their life, or charities, you know, this is somebody that will benefit from that wonderful decision that was made back then. Thank you so much for today. It was such a wonderful conversation. I highly recommend your research, your book, and everything you've been putting out to the world about the work that you do. But you opened my eyes to a whole new universe of companies. I think it's wonderful to challenge yourself that way and appreciate what it takes to find true winners. The key thing is patience. It's going to take time. Dede, thank you so much for today.
Thanks for having me. It's a real honor, and I'm looking forward to listening to your other episodes as well.
And I'll see you in Omaha in a week.
See you in Omaha.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.